Bill, I want to start off first with this idea of the bubble itself and sort of what the metrics you're using to, I guess, make that judgment call that this is indeed a bubble or bubble territory.
Well, the first thing you see is just the equity market valuations are really stretched. If you look at the Shiller-K ratio, it's at 41. The all-time high was 44 in December 1999. The average over the last 25, 30 years has been about 17. You look at the real equity risk premium, the excess return you get for holding equities compared to Treasury inflation protected securities, 1.1% excess expected return, less than half the average we've seen since 2010. Look at the Buffett indicator, which is just the U.S. market cap to GDP ratio. It's currently around 240%. Buffett said that the stock market was at a risky point when it was above 100. So we're at 240%. So the first thing is just you look at valuations, and then you think about what's actually happening in the cycle. There's a huge investment boom going on in artificial intelligence. And this year we're getting tremendous impetus to the economy from that. But the impetus in 2027 is almost certainly going to lessen because it's not the level of investment, it's the change in investment that matters. And the change in investment also matters for earnings growth of the suppliers to the AI hyperscalers. So I think that that's another thing that's going to start to weigh in the market is that you're going to start to see a slowdown in the boom itself. And when the boom slows, that means profit growth expectations are going to come down, and there's going to be downward pressure on profit margins. So just like you had a really great story on the way up, expanding profit margins, higher volume. On the way down, you'll have slowing volume growth and more constrained profit margins. And the last problem you have for the AI is just the fact that are the AI hyperscalers going to be able to generate the $2 trillion of revenue they need to justify their investment?
Yeah, well, absolutely. And we're going to get there in a second. But I do want to go back to the financing thing because, and we know, obviously, these levels can't sustain themselves. But then you talk to, the CEOs of these companies or the analysts who cover them, and they all seem to think, at least for the next 2 or 3 years, that we're going to continue to kind of see this type of spending. And there was a story that just crossed the wire before you came on Broadcom helping to arrange a financing deal for $60-70 billion. It seems, I know it's not never ending, but when I hear, okay, 2027, that's around the corner. You don't think that some of these tens of billions, hundreds of billions of dollars that have already been announced and the idea that they keep raising their CapEx numbers, you don't think that that is going to continue much longer?
Well, I think CapEx in 27 will be higher than 26, but the increase in CapEx in 27 will be smaller than the increase in 26. Also, if you look at the financing, it's much less by the hyperscalers doing it out of their own cash flows on their own balance sheets. So it's getting pretty incestuous as the suppliers are lending to the hyperscalers, and private equity is obviously, private credit's doing their own piece. So you're also getting greater opacity in terms of how this is actually being funded. The way it comes to an end, I think, is pretty simple. Profit margins, the whole thing starts to slow. Profit margins start to be compressed, and then the expectations of future profits get diminished, and the stock market's the discounted present value of future earnings. If you start pushing down earnings expectations, that flows back to the stock price at present. Another issue that doesn't get a lot of attention is also the supply of equities is going to increase. We've had some really big IPOs this year, and the lockups on those IPOs are going to end. And so you're also going to have a greater floating supply of equities that has to be absorbed by the marketplace.
Yeah, and speaking of which, I mean, we reported earlier today, the Anthropic, which is looking to come to market, is now looking like it might actually be as big, if maybe not bigger, than SpaceX. I do want to get your thoughts specifically, though, on this idea of the revenue and profitability catch up to all of this CapEx spend. I mean, you can put the numbers on a piece of paper and you can see how ambitious this spending is, and the idea that you do not have a revenue stream, at least right now, that's commensurate with that spend. Is this just kind of a redux of what we saw with the dot-com build-out or the telecom build-out or even the railroad build-out?
Yeah, I mean, I think it is, because I think everybody wants to be first, because this is a winner-take-all kind of game. So everyone's putting all their chips into the table, and at the end of the day, what's probably going to happen is you're going to end up with overcapacity. And when you end up with overcapacity, you lose the ability to have a lot of control over pricing. And so your ability to charge what you want to charge to justify your investment starts to become impaired. Look at the railroads and the internet, telecom boom, all those things did great things for the economy. So two things can be true at the same time. The technological innovation can be really transformative But at the same time, you can have an investment boom and bust. And in fact, if you look at history, it tells you that that's usually the case. So the question here is really just really not whether it's going to be a turn from a boom to a bust. It's really a question of timing and magnitude.
Well, the hyperscalers, I mean, they would make the argument, they have made the argument publicly that even if there is sort of some excess capacity from this data center build out, the idea is that, meaning excess capacity for the AI specific stuff, that the idea is that there's still enough sort of computing and cloud computing business, non-AI stuff that all of this equipment and these facilities can handle. Is that just kind of a little bit of a red herring in your view?
Well, I just think the magnitude of the investment is so great relative to what we've seen historically that it's sort of hard for me to imagine that just sort of cloud computing it by itself could take up all this capacity. We're talking about an extraordinarily large increase in magnitude, orders of magnitude increase in compute capacity. Now, it's fine. I mean, that can turn out to be very useful, but at the end of the day, is it all going to be needed?
Yeah.
And two, are people going to be able to price for that? With
regards to the economic impact, do you not buy into this idea of the productivity improvements and enhancements that AI will bring or may bring or maybe has already brought for some companies?
Well, I think there's going to be significant productivity enhancements, but it's not clear that the productivity enhancements necessarily all go to the AI providers. Historically, you look at a lot of innovations, a lot of the excess returns get competed away. And why shouldn't they be competed away in this case? It's not like we have one AI innovator. We have like 7 or 8 different firms that are going all into this space. We're probably going to end up with 2 or 3 that are really turn out to be viable in the long run. But getting from the 7 or 8 to the 2 or 3, I think is going to be pretty painful.
What about the cost of capital? That's gone up. We've actually seen some issuers that had borrowed at one rate maybe a few months ago, coming back to market and paying, several, tens of basis points more than what they had. And of course, you have this huge move that we've seen in long-term Treasury yields just over the past couple of months, to be honest, with a 30-year yield at 5.3%. Does that factor in to this maybe AI boom slowing down?
Well, it weighs on valuation, right? I mean, obviously, if we have higher interest rates, that's a competition of bonds with the equity market. But the rise in yields, even though it's getting a lot of attention because it's very different than what we've been in for the last 20 years or so, the rise in yields really isn't that large at this point. Now, the thing that could obviously cause this all to come together much more quickly is if people start to give up on the U.S. in terms of the fiscal sustainability. The U.S. has a very large budget deficit. I think that's weighing on the bond market. And if that were to come together more quickly, you could see a higher spike in yields, and then that obviously could be the precipitating event. I mean, it's hard to know exactly what's going to be the driver of the end, but there's so many risk factors out there presently. It's hard to believe that we're just going to skate through this unscathed.
Well, with regards to those risk factors, particularly when it comes to obviously the 40 trillion on debt, and then obviously the deficit widening 6% of GDP now, and some of the measures that Scott Bessent has made with these buyback announcements to try to, I guess, keep a cap, if you will, on rates. Is that going to be enough? I mean, even in the short term, to address this issue? Absent any sort of move by Congress or anyone else, any other policymakers in Washington to get the deficit and debt situation under control?
Well, what Beth is doing is going to help very much at the margin, but reducing the amount of long-term Treasury debt outstanding, it's worth basis points, not percentage points, in terms of the level of interest rates. So it's really tactical rather than strategic. I mean, really, at the end of the day, you have to fundamentally attack the budget problem, the fiscal problem, and that requires a lot of heavy lifting. And we have political paralysis in the United States, with the Democrats wanting to do it one way, the Republicans want to do it a totally different way, and as a result, nothing gets done. I mean, just look at Social Security. It's not that many years now to where Social Security is going to be fully insolvent. And the fact that we're not even fully strongly debating that and taking that up in Congress to decide how to fix Social Security is really quite unnerving, frankly.
Well, I mean, obviously, this is a problem for the Treasury Department right now. Does this become a problem for the Fed, Bill, particularly against the backdrop of a new chair, Jackson Hole, about a week from today, I believe, where, investors are going to want to hear something. I'm not sure we're going to get it, but they're certainly going to want to hear from Warsh and the others as to exactly what the game plan is.
Well, the Fed has to take the world as it is, and if the U.S. is pursuing an unsustainable fiscal path, that just makes the job on the Fed a lot more difficult. If you start to have fiscal consolidation, that would obviously slow down economic growth, and the Fed could respond by lowering interest rates. But at the end of the day, the Fed is just stuck with the world as it is, not the world that it wants to be.